FAR.F5.M3.
Jenna, consolidated financial statements are accounting's version of saying, these companies are legally separate, but economically we're treating them like one household.
That works, Russell, with one warning. The parent and subsidiary still maintain separate legal books. Consolidation happens through worksheet adjustments and eliminations, so the group can be presented as one reporting entity.
So the first mental model is simple. Separate books, one economic picture.
Exactly. And the starting question is control. Under the voting interest model in this module, ownership of more than 50% of the voting stock generally means the investor controls the investee and prepares consolidated financial statements.
But generally matters. More than 50% doesn't automatically mean consolidation if control is doubtful because of bankruptcy, legal reorganization, or severe foreign restrictions.
Right. The exam may hand you the ownership percentage, then quietly include facts showing that actual control is missing. Read the facts, not just the number.
Now suppose the parent owns 80%. The other 20% is the non-controlling interest.
Correct. The parent has control, but outside shareholders still own part of the subsidiary. The strange part is that the consolidated statements include 100% of the subsidiary's assets, liabilities, revenues, and expenses.
That feels wrong at first. Why report 100% when the parent owns only 80%?
Because consolidation is based on control, not merely ownership percentage. The group reports the entire controlled subsidiary, then separately identifies the portion of equity and income attributable to the outside owners.
Like controlling an entire apartment building while owning 80% of the economic interest. You still report the whole building under your control, but you acknowledge that part belongs to someone else.
Good analogy, with one limitation. The parent doesn't legally own each subsidiary asset directly. The subsidiary owns them. Consolidation simply makes the legal walls transparent for financial reporting.
Now we get to the acquisition method. This is the framework holding the whole module together.
At the acquisition date, the subsidiary's identifiable assets and liabilities are measured at fair value for consolidation purposes. Identifiable and tangible assets are also recognized at fair value, even when the subsidiary never recorded them on its own books.
Then, we compare the fair value of the subsidiary as a whole with the fair value of its identifiable net assets.
Yes. The acquisition price plus the fair value of any non-controlling interest represents the fair value of the subsidiary. If that amount exceeds the fair value of identifiable net assets, the residual is goodwill. If it is lower, the difference is a gain.
Buying a company is like buying a furnished restaurant. You value the building, equipment, inventory, brand-related intangibles, and liabilities. Whatever price remains after those identifiable pieces are measured is the premium for the operating business as a whole.
That captures goodwill well. Just remember that goodwill is not independently valued like a separate chair or oven. It is the residual.
The textbook organizes the acquisition date elimination with CAR in big, which sounds like someone shouting in a parking lot.
But it is useful. C is the subsidiary's common stock. A is the subsidiary's additional paid-in capital. R is the subsidiary's retained earnings. Those subsidiary equity accounts are eliminated.
Because consolidated equity is not the parent's equity plus the subsidiary's equity stacked together.
Exactly. Then I is the parent's investment in the subsidiary, which is eliminated. N is non-controlling interest. B is the balance sheet fair value adjustment. I is identifiable intangible assets. G is goodwill, or a gain when appropriate.
The reason the investment account disappears is double counting. The parent's investment account represents a claim on the subsidiary's net assets. Once consolidation shows the subsidiary's actual assets and liabilities, keeping the investment account would count the same economics twice.
Think of the investment account as the label on a sealed box. The subsidiary's assets and liabilities are the contents. Consolidation opens the box, reports the contents, and removes the label.
That's annoyingly clear, Jenna.
I'll accept that as praise.
Acquisition date versus year-end is another trap. At acquisition, we focus on the subsidiary's pre-acquisition equity and fair value adjustments. At year-end, we also account for post-acquisition income, dividends, and related amortization.
Under the equity method on the parent's separate books, the investment account generally increases for the parent's share of subsidiary income and decreases for dividends received. It may also decrease for amortization related to acquisition date fair value adjustments.
So the investment account is like a running tab. Purchase price opens the tab, subsidiary income adds to it, dividends reduce it, and certain fair value adjustments reduce it over time.
That analogy works. But remember, the adjustment depends on the asset. An undervalued depreciable asset creates additional depreciation. A finite-lived intangible creates amortization. Land does not create periodic depreciation, and goodwill is not amortized.
That exception matters. Never hear fair value adjustment and automatically start amortizing.
Correct. Ask what asset received the adjustment and whether that asset has a finite life.
Now, push-down accounting. The name makes it sound like someone is forcing accounting downhill.
Push-down accounting is an elective choice that allows the acquired company to remeasure its own standalone financial statements using the acquisition date values established by the acquirer.
Normally, the fair value adjustments sit on the consolidation worksheet. With push-down accounting, those values are pushed onto the subsidiary's own books.
Exactly. The option is available when a change in control occurs. It must be elected in the first reporting period in which that change occurs, and the election is irrevocable.
So this is not a trial subscription.
Definitely not. The acquired company records identifiable assets and liabilities at the acquisition date amounts, and goodwill is recorded as part of the push-down accounting. A bargain purchase effect is recorded in equity rather than as income on the acquired company's standalone statements.
Now the section everyone fears: intercompany transactions.
The governing principle is simple. A consolidated group cannot earn revenue, incur expense, owe money, or create profit by transacting with itself.
And the elimination is 100% even when the parent owns less than 100%.
That is a major passkey. Do not eliminate only the parent's ownership percentage. The entire transaction occurred inside the consolidated group, so the entire internal effect must be removed.
The easy eliminations are mirror images. Intercompany accounts receivable and payable cancel. Intercompany interest income and expense cancel. Intercompany dividend receivables and payables cancel.
Intercompany bond transactions add a twist. If one affiliate acquires another affiliate's bonds from an outside investor, the consolidated group is treated as having constructively retired the debt.
Legally, the bonds may still exist. Economically, the group owns its own debt, which makes no sense on consolidated statements.
Right. The bond liability and bond investment are eliminated. The difference between the carrying amount of the debt and the amount paid by the purchasing affiliate creates a consolidated gain or loss.
Inventory is where the internal profit problem becomes obvious. One affiliate sells inventory to another, but the group has not earned profit merely by moving goods from one corporate pocket to another.
First, eliminate the intercompany sale and the related intercompany cost of goods sold. Second, determine whether any internal profit remains in ending inventory.
Suppose inventory cost the group $100 and was sold internally for $150. If the buyer still holds it at year-end, consolidated inventory must be reduced back to $100.
Exactly. The $50 internal profit is unrealized because no outsider has purchased the inventory.
The textbook's pass key gives a great decision rule. If the inventory was sold to outsiders, correct cost of goods sold. If the inventory is still on hand, correct ending inventory.
That rule tells you where the deferred profit is sitting. Still on hand means it remains embedded in inventory. Sold externally means the group has now realized the profit, so the correction runs through cost of goods sold.
Land follows the same one-entity logic. An intercompany gain on land stays unrealized until the land is sold outside the consolidated group.
Correct. Consolidation removes the internal gain and restores land to the group's original carrying amount. Because land is not depreciated, the deferred gain does not unwind gradually.
Depreciable assets are different. We still eliminate the intercompany gain and restore the original group basis, but we also correct depreciation.
Yes. If the internal sale price increased the asset's basis, the buyer's depreciation expense is too high from the consolidated perspective. Consolidation reduces that excess depreciation over the asset's remaining life.
So land waits for an outside sale. A depreciable asset gradually releases the deferred gain through depreciation adjustments.
Exactly. That distinction is highly testable because the starting principle is the same, but the later year treatment differs.
Let's connect all this to the actual statements. The consolidated balance sheet includes 100% of the parent's and subsidiaries' assets and liabilities after adjustments and eliminations.
But the subsidiaries' equity accounts are removed. Non-controlling interest appears separately within consolidated equity.
The consolidated income statement includes 100% of the parent's revenues and expenses and 100% of the subsidiaries' post-acquisition revenues and expenses.
Pre-acquisition subsidiary activity is excluded. Then consolidated net income is allocated between the parent and the non-controlling interest.
The same idea carries into comprehensive income and the statement of changes in equity. Show the whole controlled group, then identify the outside owner's share.
Exactly.
The acquisition year statement of cash flows has one especially important issue. The acquisition is an investing activity, but the cash outflow is based on net cash paid.
Meaning the cash purchase price is reduced by the cash acquired with the subsidiary. If the parent pays $2 million and acquires $300,000 of subsidiary cash, the investing outflow is $1,700,000.
Because some of the cash paid effectively came back inside the acquired company.
Right. Acquisition year cash flow preparation is also harder because the beginning consolidated balance sheet does not yet contain the subsidiaries' assets and liabilities. Those acquisition date balances must be considered when analyzing changes during the year.
In later periods, things become more normal because both beginning and ending balances are already consolidated.
And intercompany cash flows are eliminated. Dividends paid by the subsidiary to the parent disappear in consolidation, while dividends paid to non-controlling shareholders are financing outflows.
Let's close with the map. Control tells you whether to consolidate.
The acquisition method measures identifiable net assets at fair value and recognizes goodwill or a gain as the residual.
The investment account and subsidiary equity disappear because keeping both would double count the same underlying net assets.
100% of the controlled subsidiary is reported, then non-controlling interest identifies the outside owner's share.
All intercompany effects are eliminated 100%.
And whenever you see internal profit, ask whether the asset has left the consolidated group.
If it has not, the profit is generally unrealized. If it has, figure out how realization affects cost of goods sold, depreciation, or the eventual outside sale.
CAR in big is the memory device, but the real understanding is one economic entity, no double counting, no internal profit, and clear presentation of outside ownership.
Separate legal walls, transparent economic reporting.
That is FAR.F5.M3.